Hi, everyone. It's Megan from Your Accounting Sidekick and Sidekick Accounting. And I wanted to talk to you today about rental properties. So, for most people that have rental properties, the intention was to use it as a way to make additional money. And it definitely is that. That is definitely one way that you can make money. Through rental properties. So a lot of times I've seen people buy duplexes or side by sides, and eventually they go on to purchase a home. So then they rent out both sides of the property, or that's what happens in general. They buy a smaller home, they move into a bigger home, and then they have this rental property. Or sometimes people have an intention of owning other rental properties. So they start buying properties and fixing them up and then renting them out. And this is a great way to make additional side money. It's a great way to add to your asset portfolio. It's a lot of great things that can happen to by renting out properties, right? I know some people rent or purchase houses in other states so that they can go and have like a vacation home, and then the rest of the year they're renting it out or what have you, right? So that there's many different options when it comes to having rental properties. However, there are also some tax ramifications that can happen when you are not prepared for having a rental property, or eventually selling that rental property. So that is what I kind of wanted to just run through a little bit today, not in anything in depth, but just to kind of get the conversation started. And it's tax season, so a lot of questions come up. So one thing is that when you own a rental property, it is something that is to your advantage because you get to write off, you know, repairs and maintenance, renovations, the mortgage interest, utilities, all of that kind of fun stuff. But what you might not know is that when you get to a point where you maybe decide you don't want to have a rental property anymore and you sell it, all of the profits that you get from that, because you've been deducting expenses for over a period of time, are all now gains. So you have this profit that you get off for selling the property because you've been writing off all the expenses over the years, and you have this realized gain that you now have to pay taxes on. And if you're not prepared for it, it can be really significant. Now, there's a couple of workarounds. One is that you can reinvest that money into some kind of a tax savings spot. You can also do something called a 1031 exchange, where you buy another property with the proceeds from that and are able to forego that capital gains tax that you pay on it. The other thing too is that unless you are a licensed real estate professional, the losses that you may have from your rental property, because again, you're writing off things that are not actual money that's coming out of your pocket per se. You can have things like mileage, you can have your mortgage interest that you're making payments on anyway. So sometimes it can feel like they're in the background expenses, if you will, coming out. So then what ends up happening is, if you didn't have a renter for all the whole year, or maybe you undercut the amount, you may end up having a loss on that rental property, and that is something that is going to reflect on your taxes as a passive activity loss. So what that ends up doing then is, if you are above a certain income limit, it's not going to have any effect on your taxes for that tax year. But eventually, when you get rid of that property, those are things that you can then deduct against it. But again, if you're not prepared and you didn't know, and all this stuff you didn't plan ahead, it can be a huge impact on your taxes, or on you when that bill comes due, so to speak. So it's good that if you are thinking about getting into the rental property, or if you have a rental property and you're thinking about selling it, or you're adding more to it, or whatever it might be, to look into it. The workaround is that you could get a real estate license and then have it be something that is not passive activity anymore. It's something that would be active activity. So then any losses that you get to deduct right away. But the other thing is finding out about that 1031 exchange. If you were to sell your property, what does that look like for you? What can you do to mitigate the tax implications? And it all comes down to planning, right? So we are big planners at Sidekick Accounting. We believe that when you plan, that you have a direction to go into, but then you are also more prepared for what's going to happen. So planning is really essential when it comes to your taxes, but also just your finances in general. And so if you haven't already talked to a professional about it, or you need to because you're a rental property owner, you're planning on owning properties, or you are planning on selling a property, make sure you talk to a professional accountant before the end of the year or before the transaction happens, because the 1031 window is a small window that you have to do something in before you're no longer able to do anything when it comes to your taxes. And so often, being a tax preparer, we get situations that come up for people and it's too late to do anything about it. So we really want to be proactive when it comes to being business owners. We want to be proactive when it comes to our money, because when you plan ahead, you have a direction to go into, but then you can also avoid some very costly mistakes that end up coming up. So that is my little tidbit for today. The truth about rental properties, they're great, but you got to make sure that you're planning and being proactive to what you need to know as a rental property owner. So hopefully this was helpful. If you have any questions, let me know. Feel free to like our page, Your Accounting Sidekick. Our link is in the bottom of the window. Please join us. We're going to start ramping up videos again because there's so much information people need to know about. And we want to change the statistic that 8 out of 10 small businesses fail. And sometimes you have a number of rental properties, that's something that you can make into a business, and are able to take even more benefits from doing it that way. So feel free to reach out if you have questions. Otherwise, thanks for joining me today. Stay tuned for more information this week. Have a good one.